banks have a pretty good early read on where things may be headed. So let's speak with a big one now. Joining us, Valley National Bank Chairman and CEO Ira Robbins. They trade under the ticker VLY, $62 billion in assets, thousands of teammates, 200 branches across the country and offices.
Yep.
So Ira, welcome.
Thanks. Great to be here.
You have a great read, particularly on the Mid-Atlantic, but a lot of GDP is produced in this region, by the way. Are your clients and your customers not borrowing money because they're afraid?
So they're borrowing. Maybe just let me give you some backdrop to the type of clients we have. And that's a little bit different than I think than what you're maybe hearing from some of the other individuals that have been talking on TV recently. We hear about large corporations that are publicly traded, right? Their time horizons as to how their CEOs think about their businesses are 6 to 18 months, right? The clients I talk to are largely generational families, small, mid-sized entrepreneurs. Their time horizon is much longer. If you ask me, are they buying? The answer is yes. Is there chaos in the industry as to their concern? Without question. But they are still moving forward on a lot of their purchases, and there's a little bit of noise without question, but the economy in their mind is still strong.
What's so contrarian about that is that we're told if this is how big business is doing, imagine how much worse it must be for small business that doesn't have the resources that they do, and they're facing all this uncertainty. But you're telling us, and again, maybe it's the kind of customers you interface with, but you're telling us almost the opposite.
I would say maybe there's an ulterior motive. I was in Alabama last week, which we have a very large client base there, logistic companies, trailer companies. 80% of the table of dinner I sat with, positive about what was going to happen. A little bit negative on the short-term instances, but from a long-term perspective, very, very positive about where the economy
That's funny
headed.
because I actually talked to a guy yesterday who works for a New Jersey company that's building a giant warehouse in Alabama. Randomly. They're not stopping.
No.
They're still building the warehouse, which means they're still going to hire people to work in the warehouse.
You know, there's this old Yiddish saying, right? We make plans and God laughs, right? And I think large corporations don't adjust to that too well. Smaller corporations, entrepreneurs, they adjust to that. They're more resilient, I think, as to how they think about their individual businesses. I was talking to some real estate developers last week. Commentary surrounding, are we looking at doing something now or are we slowing back? They sat there and said, we went through COVID, slowed down. Went through a rise in interest rates, slowed down. We're not slowing down now. Steel, some of the other attributes, maybe 5% of the overall cost. The larger cost are interest rates. Larger cost are employees. Those are more level and more common in their minds. So they're moving forward.
And when they come to you, it sounds like you're not being conservative either, because they could easily come and say, we want to see through this. And you could say, well, we don't, but it sounds like you're still willing to extend that capital.
I think we are. Banks in general, you look at the commercial real estate asset, which has been under fire for the last 18 months. I mean, there's been a laser beam focused right on it. Credit spreads have come down 70, 80 basis points from where they were a year ago. There is a lot of liquidity coming back to the market and supporting capital investment today.
What does that mean in sort of for the non-bond investor, commercial real estate expert out there, where you just said that we saw the spreads widen or narrow? And what does that mean in plain English?
I think it means from a liquidity perspective, do developers, do people thinking about refinancing their business, are there places for them to be today to refinance? The answer is without question, yes. 18 months ago, you had to rethink where I was going to get capital from for a new product.
That's critical. And we've talked a lot about this and sort of waiting for the commercial real estate doom that's never come.
Right.
Okay. So let's say you got a 3-story, pretty big office building in Morristown, New Jersey, kind of near where you are. Just randomly throwing that out there. $100 million building, whatever it is, coming up for refinancing. The owner of that building, you're saying right now, could get refinanced. Like they could stay.
Without question. And a year and a half ago, he or she would have had to contemplating putting capital in, right, if they were looking at refinancing to a lower rate or whatever, to make the economics work. Today, they don't have to worry about putting capital in. They can get the economics work out of it, and then they can go ahead and look at what they're doing with their next project. It is a very different dynamic today than what it was 18 months ago.
And how is that possible, right? So if do you feel competitive pressure from private credit that, like, if you don't do these projects or extend that capital, that they'll step up and do the same thing? Because you'd think, just obviously speaking, risk assets are down, like you said, spreads are wider, the economy, the outlook is uncertain. So aren't banks supposed to kind of like pull back and just kind of be on the sidelines, wait and see? Or maybe you've never felt that pressure?
No, I think we definitely felt that pressure, right? And I think we have the most unbelievable economy in the United States because we have so many different diverse contributors of where capital comes from, whether it's banks, whether it's private credit. There's a multitude of different places. 18 months ago, private credit absolutely stepped in where there was a bank void. That said, today, banks are able to be back in the marketplace. There's less regulatory scrutiny associated with what's happening in the commercial real estate. As you alluded to, those losses largely never materialized. I've been CEO for 7 years. The cumulative losses at our bank over a 7-year period are 89 basis points.
Wow.
Over 7 years.
Cumulative.
Yeah. Yet we have a riskier asset class. People were modeling 89 basis points for commercial real estate just for 1 year. We're talking 7 years. Those losses haven't materialized, and there's capital that's now available to borrowers today.